Okay. That's just a general proviso that I'm not a financial planner, so I can't give any financial planning advice. I'm purely here to talk about tax from that side. But the first thing I want to say is when you buy an investment property, it doesn't matter whether it's a property or shares or whatever, it should always be done on the basis that the investment itself stands on its own 2 feet. What I mean by that is, if you buy a property and you're trying to make it work for you by getting a tax break, I would always advise against it. Okay? The investment in the property should stand on its own 2 feet first up, and then if you can get a tax benefit out on top of that, that's a bonus. Okay? That's my basic principle in life. Doesn't matter whether it's property, shares or whatever. The investment must stand on its own 2 feet to start with. Okay? Jeremy talked about negative gearing, and what we're seeing a lot in the market now is also positively geared. Okay? Now, back in the old days, for those of us who were buying houses in the 80s and 90s, real estate was probably going up 7-8% a year on a regular basis, and there was good capital growth in there. So if you're a high income earner and you're looking for some sort of tax break, you would negative gear a property, which basically meant that the expenditure on the property was greater than the income. Does that make sense to everyone? So you're actually running at a loss. One of the issues without running at a loss is it's a physical cash loss that you have to be able to fund by other income. Okay? So that's what people misunderstand. When people hear about negative gearing, I think it's a great tax break and it's a great concept. But it does actually create a cash loss in the short term. I can tell you one thing now. People heard recently about the Commonwealth Government talking about doing away with negative gearing. I tell you, they won't do it. One of the reasons they won't do it is because too many of them own properties themselves, which is always a good reason not to do it. Secondly, negative gearing only works if you've got a 25-year loan, for example. Negative gearing will probably work for the first 10 years. After that, it becomes positively geared anyway. So after about year 10, the government starts to collect tax anyway, and the day you sell it, you pay capital gains, so the government will get tax as well. So over the long term, the government's actually going to be more better off with negative gearing in place than getting rid of it. So my belief is they probably won't get rid of it for a lot of reasons. Okay? Positively cleared simply means that at the end of the day, you're generating more income than you are expenses. And I would suggest in the current market, that's not a bad option. But again, I'd also suggest that you talk to your financial planner and work out what your own individual strategy is. The reason why I say that is because if you're positively geared and interest rates go up 1%, it's not going to affect you. Okay? If you're running at a negative gear and you're not earning a good income, interest rates go up 1%, you've now got another cost you've got to meet somewhere. Okay? Does that make sense to everyone? So right now, where there's not a lot of growth in the market, my leaning is more towards positive geared properties than negative geared. Because basically negative geared properties were really people on 100,000 plus income, probably 150 these days, a lot of spare cash, and we're looking to grow long-term wealth. Okay, so they can negatively gear into that process, get some good tax benefits, and grow long-term wealth again. Which was one of the couple of the reasons why Jeremy said, why would you purchase property in the first place? Long-term capital growth and good returns. So to have negative gearing, you must be able to get good capital growth over time. Otherwise, there's no point to it. Positively geared, as long as you're getting some capital growth over a period of time, I'll give it to keep moving anyway. But that's the main thing about that. Okay, and we've already covered off there why you'd want a negatively geared, so I'll just slip past that. When you purchase a property, there are some depreciation assets in that property, which is your stoves, kitchen, bench, fridges, all that sort of stuff. And there's the actual cost base of the property itself. You need to actually pull those out to determine what the capital gains is going to be based on, okay? It's one of the reasons why you always want to get a tax depreciation schedule done on a property you buy, even if it's an old property. Those schedules normally cost about $700, $650 to $700. But again, for that price, they're well worthwhile. I was just talking to someone before who's bought a property that's about 20 years old. Was it 10 years old, I think I went, sorry. And they were saying that the benefits out of that, young Andrew, was it, in fact, Yeah, it's saying the benefits out of a 10-year-old property were still substantial. And most of those depreciation schedules will run for 25 years. Okay? So if you've got a new house, they're definitely worthwhile. But if you've got a house that's, say, 30 years old, I would suspect that there's probably been at least one major renovation done on that house at some stage, which will still give you good depreciation. I'm not going to go through each one of these, but certain costs are automatically deductible, which means you can claim them in your tax return each year. And some are based on a cost base, so you won't actually get those back until you work out what the capital gain is when you sell it. Okay, but it lists them out there, and they're in the handouts in the brochure there, so I'm not going to go through those with you. Something that people ask a lot and don't fully understand, if you're looking at buying an investment property and you go along to seminars where you go around, you fly to South Australia to have a look at a property and you fly back, they're not tax deductible, okay? Because they're not associated at this stage with actually generating income. They don't have a sufficient connection with the income generation in the future to be tax deductible. So if you think, oh, I'm going to go all these trips all around the countryside looking at houses and going to claim a tax deduction, unfortunately it's not going to work for you, okay? And the same if you go to seminars, okay? So if you go to a lot of seminars trying to learn up, unless you're in the business of actually owning property and living off that property, investments, which most of us aren't, so in other words, if you own one or two properties, it's not your business. It's just an investment, okay? So you're not going to get tax deductions for them. Now, this is one area where it becomes critically important if you're renting, okay? Are you genuinely trying to rent the property? Because a lot of people, when they buy investment properties, funny enough, would like to buy at the Gold Coast or the Sunshine Coast. They would like to spend weekends there. Does that sound familiar? Okay, in most cases, at the best, you're going to be able to proportion the cost of those sort of rentals. Because the question the tax officers don't look at straight away is, how serious are you about actually renting that property out? So if you rent it out for 4 weeks at Christmas, but you keep it for the rest of the year so you can have private use, you're only going to be claimed 4 weeks or 4 divided by 52 for your cost, okay? So if you think you're going to be able to get huge costs or huge savings out of your cost when you're only going to rent it 4 or 5 days a week, or if you don't even make an effort to actually rent it properly. So one of the things the taxman will look for, have you used a real estate agent to try and actually rent it? What was the process you went through to try and rent the property? And if they don't think you've made a genuine effort, you'll have a problem claiming deductions on it, okay? If you rent it out to your brother at half the market rate, the tax office will say, yep, we'll accept that, but we'll only allow you to have deductions up to the amount of income. So if you're selling it if you're renting out at a cheap rate and maybe you're getting $5,000 worth of rent a year, they'll only allow you to claim expenses up to $5,000. So it becomes neutral. But you may well find in that case, if you're renting it out cheap, your cost may be $10,000, $15,000. So you're going to be out of pocket $10,000. Okay, does that make sense to everyone? Okay. Jeremy spoke about the legal ownership of the property, and for tax purposes, the income from that property is split according to the legal ownership. Okay? So if in fact you own the property with your partner and it's 50-50, you can't come when it comes tax time and say, well, the partner only actually earns $20,000 a year and I earn $150,000 a year, so we'll work out which one's the best advantage tax-wise and we'll put all the income to that one. Sorry, it doesn't quite work that way. If you own property in equal partnership, 50-50, the income or the benefits from that is split 50-50. Okay? Same if you're buying a partnership or any other way. You have to allocate it in accordance with the ownership. I've already spoken about the fact that if you want to claim expenses, it really does need to be at a commercial rate, the interest rate. And I think I've covered off on most of those.
Sorry, that's only if it's a family member or someone who's been...
It must be at a commercial rate. Okay? So if you're going to lend it out to your son's friend at a below commercial rate, then you're going to be in trouble. In other words, what they're basically saying, if you're going to make tax deductions on it, it has to be at arm's length. And normally what I'd say to a client to make sure that's correct, you would go to a real estate agent and ask them what the commercial rent on that property would be. And if you charge somewhere around there, you'll be okay. Because I'm sure if you went to 3 different real estate agents, you can get 3 different rental prices. As long as you use the average, you'll be fine. So if Robin said to you that property's worth 350 is a rental, if you charge 340, you'd be probably fine. Okay? If you charge 200, you'd be in strife. Okay. Normally, if you borrow for a rental property, 100% of the interest is deductible. Okay? Now, what happens if you decided after 6 months to move into that property? Or vice versa, if you've got your own residence and you move out and then you rent it out, is the interest deductible or not? And one of the things that happens with a lot of loans is how many people here on the home loan, for example, at times make advance payments? Fairly regularly? And who here at times draws down on those advance payments? What I found interesting, in the last 12, 18 months, a number of young people have came to me and said, look, Dave, I've got my residential property, but we want to pay it down quicker. So what we're going to do, we're going to move out and we're going to rent that property for the next 3 years. The first thing I say to them, give me a look at your loan account, and if I find that they've actually made advance payments and then withdrawn those advance payments to, say, buy a boat or finance a car, that redrawing is actually private in nature. So if you then move out and rent that property, most times you have to refinance the loan to make it a clean loan again. Otherwise, it's what they call a mixed loan, and that creates a lot of problems. Okay? A lot of problems. So what I always suggest to people, whether it's your private residence or it's an investment property and you want to make advance payments, set up an offset account. It's the best thing in the world. Reason why? Any money that goes in that offset account can be drawn out at any time you like, and it has no impact upon whether it's deductible or not if you go into that type of situation. So if you're buying your own main residence and you're going to have a residential, but you're thinking down the road, well, geez, I might move out for 12 months and get someone else to pay my own house off, then I'll move back in later, do an offset loan. Because if you redraw on that, it has no impact whatsoever. But if you do it through the actual loan itself, then redraw it, it creates problems. Okay? Any questions on that?
What if you get an advance on investment property? Can you redraw some of that?
You get an advance for an investment property?
No, if you've paid extra into an investment property,
Yep.
and then 6 months later you decide to pull that out.
For what purpose?
Not buy a car or
As soon as you buy a car with it, it becomes private in nature, so you create a problem for yourself. If it's an investment property. That's why I always say, if you create an offset account and you put it into there, you can draw it back out, no troubles whatsoever. But the problem you get when you draw that back out of the investment one, you've now got a portion that's income earning and a portion that's not income earning. Now, there are examples where someone's done that and they said, oh geez, I made a blue there, I've created this private portion, so I'll now take that 30,000, I'll pay it back in, and they'll square everything off. Sorry, it doesn't work. Because what they'll say, that $30,000 repayment now has to be a proportion between the business portion of the loan and the private. So 20,000 may go to the business and 10,000 will go to the private. So you can't pay the 30,000 back once it's out. Okay, so it's got some real issues. And that's why when people come to me and they start talking about what sort of loan I should get a house or set it up, that's the things I actually talk about to try and stop tax problems further down the road for you. The only real way out of that is to actually refinance the whole thing again. And that's got costs obviously associated with it as well.
If you use it as a deposit for another house, though, an investment property.
As long as it's used for generating income, yes, you can. So if you were to buy another investment property and you use that advance to do that, yep, you're fine.
But not owner occupied. No.
No, it must be for income purposes. So it wouldn't have to necessarily be, you could use that and go buy shares. As long as it's income producing, it's fine. As long as it's not private in nature. Okay? That's the key. Because as soon as you've got a mixed loan, you've got real problems with this. So you avoid them like the plague. Okay, what sort of things can you immediately claim as a deduction? And that's said, it's a fairly long list there. And again, they're in the handout, so you can have a look at that at your own leisure. And again, okay, the big thing about deductions, you must have actually incurred them. Okay? That sounds sensible, doesn't it? But it means that if you're getting your tenant to pay all these costs, and he's the one actually meeting all the costs, but you actually get all the receipts off him, you can't claim it. And if it's his place of residence, he can't claim it either, so it's just dead money in that sense. Does that make sense? Because that's one area where a lot of people think, oh, well, the tenant's paid for it, but as long as I got the receipt, I'll be able to go to my accountant and claim it as well. Land tax, which Jeremy spoke about, is important from the perspective of actually determining what sort of structure you set up in the first place. And that is important from a legal perspective in terms of asset protection and from a tax side as well. I've got the rates here. If it's an individual for investment properties, as long as the unapproved value is below $599,999, there's no land tax. Okay? And that can be a number of properties, as long as the total doesn't go beyond that.
Shit. Your principal place of residence doesn't count, does it?
It's exempt, correct. So the unapproved value, if it goes beyond 600,000, it's $500 plus 1% for every $1 over 600,000. Now what you've got to think of too is, I'm being wound up here, but I'll keep going for one more second, because I do like talking. But nevertheless, what you will find is, you buy some properties 3 years ago, and they might have been 200,000 each, that's 400,000, two properties. But over time, you've just got to be careful, because once that unapproved value gets over the 600, you're going to be up for land tax.
And when is that payable?
But it's usually assessed 30 June each year for the previous 12 months.
Oh.
And normally the Stamp Duty's office will send you a notice. So they'll get the records from Natural Resources.
Per individual?
Per individual.
So
Yep. Sorry.
like if you've bought like tenants in common and you have $1 million worth of property, is that 500,000 each?
Yes, it is, yes. Yep.
Okay.
And if you're in a trusting company, the rates are lower. Sorry, yeah,
It's usually a nice Christmas present.
it is.
Gee, they don't miss you, do they?
No, they don't.
There's a good way around that to spread your properties around different states.
Yes, it will. It will because it'll be applicable in each state. Yeah, it will be applicable in each state, or if you borrow overseas. But yeah, in each state, by the way, if you are going to buy an estate, the first thing you should actually do is check out the land tax for that state, because they vary from state to state. And Queensland's probably got one of the better ones at the end of the day. So if you're going to buy an estate, the first thing I'll be doing is just talking to a solicitor and getting the proper advice and proper guidance as to what the land tax rates are in that state before you buy.
Is that after tonight or before tonight?
Sorry?
Is that after tonight or
It's after tonight or before tonight. Preferably before
the
tonight.
budget? Have they changed anything?
No, they won't. I doubt what that'll change.
They're grabbing everything, so.
And they're the key exceptions. The main one I did want to point out there, which was the question I was asked, is your principal place of residence. Okay, it's like everything else in tax, you need to keep your records for 5 years from the last point that record was active. In other words, for depreciation purposes, if you keep depreciating each year, that means you keep adding 5 years on to the last one. So for depreciation schedules, you may need to keep those records for 20, 25 years. The only thing to wrap up with, I will also suggest, the first thing I always ask clients is when they come to me with a rental property, I'll always ask for a copy of the contract. Okay, and we'll always keep a copy. I had a client come to me 18 months ago, sold a property in Canberra, gave me a sale contract, but couldn't find his purchase contract. And that makes my job of working out what capital gains is very difficult. Because it's not so much the value, you can go back through the records and find out the value, but capital gains is actually based on the date of the signing of the contract, not settlement date. So you really need to understand when it was actually entered into. Okay? Any questions? Okay, that's great. Thanks very much.